You are listening to Keystone's Stock Talk Show, episode 304. It's great to chat with you again this week. We're back, and I will start this week with a quick look at the predictive powers of the CAPE, or the cyclically adjusted PE ratio, aka the Shiller PE, a ratio of many names, and the relative valuation gap between small and large cap stocks. Brennan will answer a viewer question on Canadian rail stocks. He will provide another great comparison of both CNR and CP. Brett answers a viewer question on small cap spec play Xtract One, symbol XTRA on the TSX. The company provides an AI-powered security system of sorts. The question really breaks down to pure speculation versus smart investing. Brett will give you his take here. Finally, Aaron will provide a summary of the top earnings stories from last week, including names such as Alphabet and Tesla. Let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees. Brett and Brennan, how are you guys doing?
Doing well.
Back from a vacation, Brennan.
Yes, I was. I was in Lethbridge, did a bunch of golfing there. I was in a golf tournament.
Sounds like a dream vacation, Lethbridge.
Yeah.
Right? When people say vacation, Lethbridge comes to mind.
Yeah, but no, it was beautiful. But one thing, when we were driving from Saskatoon to Lethbridge, like it's about a 6-hour drive, we were in smoke all the way up to Medicine Hat. So it was basically like 4.5 hours of just like you could barely see in front of you. I was surprised. The smoke kind of started to lift once we got to Lethbridge, but I was surprised that it was spanning that far. But of course, I guess with all the fires going on. Yeah,
terrible. You're choking off. We haven't got a ton of smoke down here Vancouver way this year, but we're knock on wood that doesn't happen. I know Brett had some rain in Calgary.
So Calgary's just been pouring, and that's probably why we haven't got the smoke like you guys have. So
yeah.
I like the rain. I know a lot of people are saying, "Oh, I'm sick of this rain" because it's been all of July. Effectively, I'm loving it over the smoke.
Yeah, for sure. Well, we had a few companies in the resource sector that had been in the past 2-3 years affected by some of the wildfires, and they're keeping a close eye on that, and we're keeping a close eye on that to see if it's going to affect some of the the drillers this year. It doesn't seem to be as vicious, except if you're where Brennan is. Apparently, right?
Yeah.
It's following you.
It is.
Stop throwing your butts out of the car, Brennan.
I'm sure.
Yeah. Brennan is not smoking his anyway.
No.
Just as a disclaimer. Okay. Do we want to get to the poll question? I just FYI, you can't watch it now, but I did a MoneyShow presentation, virtual MoneyShow presentation last week. I wish they would have it archived on their website, but I can say if you are in the Toronto area, we'll have some details on this in the below on YouTube in the below, and we'll also send it out in the YouTube on our email for this segment. How you can sign up for the Toronto Money Show. I'll be there on Saturday, September, I think it's 13th, 45 minutes. Giving a speech there. So if you want to come and see me, I'll shake your hand, kiss your babies, whatever needs to be done in person. It'd be great to see you there. Let's get to the poll question after that. That's terrible.
Go from that one.
I don't know. We got a July Trump. It's the Trump tariffs, right? That's what we're talking about.
Trump tariffs. Yeah. So since the start of July, he's really been releasing that next round of tariff threats on multiple countries. Unlike the initial tariff barrage in April, the Liberation Day, the broad stock markets, so your indexes have really just not reacted, really. It's the S&P 500 has just slowly moved on and up over the past few months, likely signaling the broad belief that Trump tariffs will either not be imposed or not really be impactful to the broad economy, at least at the same panic level that we saw back in April. So the question is, will the current round of tariffs stick, or will Trump chicken out like his TACO abbreviation or acronym is constantly going? 63% of reviewers say the tariffs won't stick or will be delayed further, and 37% say that tariffs will be imposed. And we saw just this last weekend, there is, an agreement or a plan of agreement at this point with the EU, and on Monday when we're recording this, I think that the euro actually dropped about 1% against the US dollar. So it's the market's thinking it's a US favored and currency favored.
Yeah, the general consensus is that it was a capitulation by the EU. That they didn't want to, either they're buying time to figure something else out, or they didn't want to like enter into a direct, more intense trade war with the United States, right? So most of what I can see, I mean, I just started really looking into it, but like most of what I could see is that it's 15% tariffs on most EU goods coming into the US, still 50% on the aluminum and the steel, a couple carve outs for industries, and then some agreement. I don't know what the time frame is that the EU will invest or purchase about 600 billion, I believe, in product from the US, a lot of defense stuff or different things over a period of time. So it was, largely like I know a lot of people in Europe. I think the Prime Minister of France was basically saying it was a dark day for Europe and an embarrassing capitulation, unfortunately. So whatever the rhetoric was, I'm sure that we'll be hearing a lot more of it in the future due to that.
Yeah, I don't think we're out of the woods in terms of the tariff story yet, but the market is
We're
certainly
barely even into the woods. We're like just starting into the path.
I think the market is starting to look at it more as noise. We'll see going forward if we see some significant economic downturn because of this, or if there's some sectors of the market that are really affected. But again, we're continuing to monitor that, and in reference to the companies that we invest in for our clients, that our clients are invested in based on our advice and that we look at as well.
I wonder how much of this, though, just kind of as an aside, is the capital needs to go somewhere, right? So typically when it's not in the stock market, it goes into the bond market, which is largely US treasuries, which don't really shield you from what's going on necessarily either. So I wonder if a lot of it is just lack of alternative. Just a theory.
Yeah, in some places, I'm sure there is. Where else do you put your capital? And I mean, at least you're getting a growing dividend in some of these businesses too, right?
Mm-hmm.
So versus.
And then, of course, you have the big
US
AI companies that are, paving the way to the future, presumably, and people want to get into that. So, obviously, capital stays there and some other exciting growth areas. So, anyways, just a thought.
Yeah. Good. All right. Let's get into the show, I guess. I can share my screen. So I wrote or penned an article, as we used to say back in the day, on basically the relative valuation gap between small caps and large caps, whether there's an opportunity. And I highlighted the CAPE ratio, and I made a very punny title there: CAPE-tivating predictions. Small caps ready to outshine in a pricey market. So very, very punny there. And there's my AI generated image. Is the cyclically adjusted price earnings ratio predictive hero? Of course. So just over halfway into 2025, I'm going to briefly look at the current broader market valuations where the opportunities may be presenting themselves. But what is the CAPE? Well, it is the cyclically adjusted PE ratio, also known as the Shiller PE. One metric, we utilize it internally and quote it to clients as a broad gauge of current market valuations. It's also known, like I said, as the Shiller PE. It's a valuation metric popularized by American economist Robert Shiller. Unlike the traditional trailing PE month ratio, 12-month ratio, which can be distorted by short-term earnings fluctuations, the CAPE ratio smooths out cyclical effects by dividing the current price of an index, say the S&P 500, by the 10-year average of its inflation-adjusted earnings. This methodology provides a more stable and long-term view of market valuations, making it a valuable tool for forecasting potential future returns and evaluating the current valuation in a historical context. Historically, a higher CAPE ratio has correlated with lower returns over the subsequent decade or two, as the ratio tends to revert to its mean. So let's just look here at some numbers I pulled. As has been the case for the majority of the past decade, the S&P ratio remains significantly elevated, S&P 500, when compared to its historical averages. As of mid-July 2025, the Shiller PE on the S&P 500 is 37.8. This represents an increase from where it was at 2 months ago of 35.2, and about a year ago where it was at 34.8, indicating continued upward movement in broad market valuations. For historical context, the 20-year average for the Shiller PE ratio is 27. The current CAPE of 38.8 or 37.81, if I could speak, is 40% higher than its 20-year average. The all-time average over the last 100 plus years for the Shiller PE is 17.6. The current CAPE is approximately 114% above its all-time historic average. So now, I note something here that we have been pointing out to clients since the mid 2023. Large caps represented by the S&P 500 continue to trade at a significant premium over small caps represented by S&P 600. It's currently around 42 there, close to the peak for this cycle. And it's widened from the peak was around 50 in November of 2023. And it's widened from 36.7 at the start of fall in 2023. So what are the implications of current CAPE levels for future market returns in reality? The CAPE ratio is not only significantly above its 20-year average, but also exceeds its long-term arithmetic mean, which was, again, 17.6. That's over 100% above that level. The current deviation, the significant deviation, implies, based on historical patterns, the broader market could be considered overvalued. The core principle of the CAPE ratio is its inverse correlation with future long-term returns. A higher CAPE suggests lower returns over the next 1 to 2 decades, as we said. This indicates that investors should adjust their long-term return expectations for the broader U.S. markets, equity markets, downwards. Relying solely on passive index strategies such as index ETFs or funds in such a high CAPE environment may lead to subdued real returns over a multi-year horizon, necessitating a more discerning approach to portfolio construction. The current market firmly set up as what we would call a stock pickers market. Near to midterm, it appears to be this type of market where identifying high quality, fundamentally strong, small and mid-cap companies can yield significant long-term returns. Recent examples of this, we've highlighted these on the show a number of times now, are picks and shovels play on AI and electrification Argon, which has jumped around 345% over the past year alone from our recommendation of around $50 this time last year to where it trades at around $320, or is it, sorry, $220 today, in that range. Unknown and profitable company called Prodex recently recommended to clients. About 18 months later, the stock was up to from about the $16 range to $52. These are examples of high quality small cap names that traded at a discount to their large cap brethren that we were able to identify and clients were able to profit from. Now, this persistent elevation of the CAPE ratio has naturally led, the persistent elevation has led to discussions about whether structural changes in the economy, such as sustained low interest rates, technological dominance of a few large firms, or efficient capital allocation, justify what we always call a new normal. You hear that a lot, of higher valuations. However, the CAPE's historical predictive power and its consistent tendency to revert to the mean suggests that such extreme deviations are historically temporary. Let's take a look quickly at the updated forward PE ratios for U.S. market capitalizations here, comparing the updated S&P 500 forward PE of 22.48 with the S&P 600 small cap forward PE of 15.8 reveals that large caps still traded a significant premium on this basis, about 42.28%, while the premium has narrowed slightly from what we saw at greater than 50% in November of 2023. it remains a substantial deviation from the first 20 years of this century, where small caps traded at a premium. This sustained, albeit slightly reduced premium for the large caps indicates that the underlying market dynamics favor large cap outperformance, such as concentrated growth, perceived safety, continue to exert influence, preventing a full mean reversion to historical small cap premiums. The narrowing suggests some revaluation or rotation within the market, but the fundamental imbalance persists. The continued valuation discount in small caps implies the opportunity to position our clients in high quality, undervalued small caps remains. So that's what we continue to do. Only high quality names, growth at a reasonable price with solid balance sheets. And there's the disclosures, and that'll end my segment. If you can catch that or grab that full article on our website at www.keystocks.com as well.
Yeah, I've definitely been seeing a lot of people saying, new normal being tossed around just with, the increase in AI here. I was listening to a podcast, I believe, not too long ago. I believe it was actually Brett that put me towards it. And, that's just what the one individual was indicating, is that, the market may start to demand, a couple turns higher of, a multiple because of AI. But again, if we're looking historically, we've heard that time and time again, and it doesn't hold up.
Yeah, we heard that with the advent of the internet and, the proliferation of the internet. And, it looked like it for a moment and then reverted to more mean long-term historical average.
Exactly.
One thing I think that is important to also take into perspective is just the difference in terms of how popular investing is now compared to how it's been over the last 150 years. Like, investing is very mainstream, right? Like, you have all these platforms like Robinhood, robo investors, meme stocks. Like, it's just with the click of a button, right? Whereas you go back, to when Warren Buffett was doing research back in the 50s, he had to drive to the library to look at annual reports or have them like mailed in like one at a time, right? And I just don't think that there was there just wasn't the level of interest, even just with the different financial products now, like the funds, ETFs, all these things. Like, it's not as household, or wasn't as household back then. So with more demand and not a commensurate increase in supply, you would expect then for the prices, or the valuations in this case, to be more extreme than they have historically. Just as another way of looking at it. But what I would also expect is, volatility as well, because when you start to get at those high valuations and people realize that they're based on expectations that are just completely, unrealistic or unfounded, once that realization sets in, we see some pretty abrupt reversals, like we saw coming out of the pandemic. After there is the pandemic, the tech boom in the pandemic, and then the complete obliteration of a lot of the stocks, many of which have not recovered since. I think that was 2022, right? Was the tech downturn, right? Like, a lot of the stocks, many have recovered and gone on to produce amazing gains. Many have not recovered. So, and that's really where, from an investor perspective, valuation has to come in. Like, how ridiculous is it?
And this is one, like, the precise reasons why we want to monitor the markets on a daily basis and buy great companies when they come on sale if there is a downturn, because you're going to see more volatility with more participation in the market. You've got people in there who quite frankly don't know what they're doing, and then you get more volatility with the popularization of investing, and it gives you these opportunities that likely wouldn't be there if you had players with stronger hands in the market to buy great companies on sale. Look at them like if you're going out there and you want to buy a car. If the car that you've done a bunch of research on, is a great vehicle for you going forward, if it suddenly came 25% on sale, you would run out there and buy that car. People have sometimes the opposite impression or effect when they see a stock go down 25%. If it's a company that we've got a ton of research on and we like that business, we are there and ready to invest in it when there is the volatility. And we have seen more volatility in the past 5-10 years than you've seen, in the previous 100 years likely in the markets. On an annual basis, you're seeing this monthly basis as well. So this is where you can take advantage of those great businesses. We were able to do that earlier this year in a company that we had liked for quite some time. It traded up to the $40 range. Fintech services the U.S. market and the U.K., and it dropped down to the $25 range when we had Liberation Day or around that point. Again, we didn't see any huge fundamental impact on their business other than general economic, and we were able to add it at a point where we likely would not have been able to buy if there weren't that volatility. So that's where if you're monitoring the markets, if you have a book of companies that you really want to buy and you see the volatility, take advantage of that, buy great companies when they come on sale. That's my soapbox. All right. Let's move on. I think Brennan, you wanted to, or you had a client or a viewer, could be both. We hope both, right?
Yep.
That wanted to look at the two Canadian big rail stocks, CNR and CP.
Perfect. So yeah, I spoke with one of our VIP clients about a week ago, and they asked me if I could go through a comparison of Canadian National Railway and Canadian Pacific Kansas City Railway. So I told them that once that I was back from my holidays, it would be first on my plate. So here we go. So I'm sure most are familiar, but CNR, they engage in the rail and related transportation business and operates a network of 20,000 miles of track and 23 terminals spanning Canada and the United States. It's currently trading at a price of about $131.40, market cap of about $81 billion, and a dividend yield of 2.7%. Now, CPKC, they own and operate a network of approximately 20,000 miles in Canada, the US, and Mexico. They currently trade at a price of about $105.40, a market cap of $97 billion, and a dividend yield of 0.8%. Now, here's what CPKC's track network looks like, spanning all the way down to Mexico. And here is what CN's railway network looks like, just if you're curious and actually want to see the map in front of you. But the last time I did a segment comparing the two was in late 2022, and this was following the big news that CP had officially acquired Kansas City Southern for US $31 billion. And as a reminder, CP had initially bid on KCS in the spring of 2021 for US $29 billion, with CN issuing its own bid of about US $34 billion just 1 month later. But the deal was blocked by the U.S. Surface Transportation Board, or STB, for anti-competitive reasons, which led to the final purchase going to CP for a few billion over its initial bid. And as you can see, since the deal went through, their performance has been relatively the same, up about 6%. If we zoom in, though, CNR has underperformed, down about 20% from the beginning of 2023, while CP is down at just 0.5%. And before I move on, I'll also note that CNR has continued to grow its dividend, while CP hasn't until its last dividend paid on June 27th of 2025. Plus, CN has provided a better dividend yield. So CN's laggard return would be offset to some degree. But let's dig into both and see why CNR has been underperforming relatively recently, and how both have been, just generally financially performing. So CN's last quarter was Q2 of 2025, ended June 30th of 2025, while CPKC's was Q1 of 2025, ended March 31st, 2025. So keep this in mind when we're looking at the numbers here. And also note that CPKC will report its Q2 results on July 30th, which is on Wednesday. So we can get a better like-for-like comparison after they report those results. This podcast will probably be posted on Tuesday, so it'll be the Wednesday that they come out with those. But we can see that CN's revenue per product line has been hit quite hard in Q2, with year-over-year revenue down across the board, except for grain and fertilizers. And if we go for a like-for-like basis, comparing CN's Q1 to CPKC's Q1. Although CN's Q1 was better than its Q2, CN's revenue by products continued to be softer than CPKC's, which if we look at the financials over the last 8 quarters, we can see more robust revenue growth from CPKC, likely led by better geographic exposure across North America and the integration benefits of KCR. Now, CPKC's diluted EPS growth was also more robust, with CN's diluted EPS up 7% and 8% in Q2 and Q1, respectively, due primarily to lower fuel expenses and the elimination of that pesky carbon tax program, while diluted EPS from CPKC was up about 18% in Q1. But I will note here just that CPKC's free cash flow lagged that of CN's in Q1. Moving on to the company's fiscal year 2025 guidance, CN is guiding toward revenue ton miles, or RTM, which is calculated by multiplying the weight of cargo transported by distance traveled, to be up in the low single-digit range, while adjusted EPS is expected to be up in the mid-single-digit to high single-digit range, which compares to its previous guidance, which was provided in January of 2025, of about 10 to 15% growth. So they revised that lower. And looking at CPKC, it is looking toward mid-single-digit RTM growth and adjusted EPS to be up 10 to 14%. So CPKC is looking at better growth. But again, this guidance was provided much earlier than CN's, given CPKC hasn't reported its Q2 results yet. So we'll see if there's a shift there when they do report on Wednesday. But before moving to the valuations, looking at the balance sheet, CN's is superior with a trailing net debt to EBITDA multiple of about 2.4 times, while CPKC's is around 3 times. And looking at the valuations, CPKC is trading at a premium across all metrics, likely given its better projected growth and potentially diversification. But following the release of its results, again, on July 30th, we will see if they end up revising this growth lower, given similar headwinds, which CN is seeing. And I'll also note that CN is trading at a historical discount on a trailing price to earnings basis, while CPKC is actually trading at a premium right now to its historical 10-year median. So to conclude, this is really a quick summary here, but just hitting the key points on what's going on. Geographically, CPKC is better diversified and has been producing better growth, which has led to its relative outperformance and higher valuation multiples. CN's balance sheet is superior with a lower trailing net debt to EBITDA figure. Now, from an income perspective, CN is likely the better dividend growth stock with a 2.7% dividend yield, while CPKC's is just 0.8%. And CN has been growing its dividend at a better pace, while CPKC's has been flat, with its last dividend being the first increase in 5 years. But CPKC's forward dividend payout ratio is just 19%, so they've got room for growth, while CN's forward dividend payout ratio is about 47%. Now, from an operating standpoint, I can understand why individuals are paying up for the growth of CPKC, but it does trade at a premium valuation to its historical multiple, while CN trades at a discount. But it will be interesting to review their results coming out, like I said, this Wednesday. And in my opinion, both do just generally face some headwinds in the current economic environment and uncertainty that's going on. CPKC has great room to grow its dividend, like I noted, and it's great to see that they recently increased it. But again, from an income perspective, CN is likely the better dividend growth stock. Just at the end of the day, I really think it's kind of a toss-up between the two, depending on what you're looking for. But hopefully this provides a solid comparison for investors on the pros and cons of each. If you have any questions on CPKC's Q2 results, which will be posted on Wednesday, feel free to comment them in, and I will personally respond to them if you have anything that you're curious about, or just you want to get kind of an opinion on the results. I'll give you a little comment there. That's it.
Excellent. Nice summary there. A good look at those two venerable old railways going forward.
Yeah. One thing that I'll say too is just, it is interesting, even just on my massive road trip to Lethbridge, just again, seeing the Kansas City rail cars. or locomotives, I guess, all over, essentially. Clearly, CP has brought some up north of the border, obviously. But yeah, was definitely seeing that all around.
Awesome. All right, let's move on. I believe Brett is going to look at Xtract One, XTRA on the TSX Venture. Kind of a speculative story offering AI-powered security systems at present. You can review that for a listener, I believe.
Yeah. This was a listener's question. They provided a couple points, which I'll just really paraphrase their question. They've been holding it for a couple years now. It's had a loss. The stock has really been coming down. They're wondering if they should double down on it. So if they should re-up their position, because obviously it's decreased. The stock has been slammed as there's been delays in growth, but he sees growth and backlog with a further catalyst once the One Gateway, a new product, hits the market with a massive total addressable market to support their growth pathway. But this is also all on the back of management claiming that they will hit break even in quarters, not years. So let's get into this company. The Xtract One, symbol XTRA on the TSX, is a provider of AI-powered security systems to detect concealed weapons in real time, looking to replace metal detectors, increasing patron throughput and reducing operating costs for a venue, so like a sports venue. Instead of going through a traditional metal detector or them waving you down with a wand, you can walk straight on through. It's easier for patrons to go through, and then it looks at if you have a weapon concealed or not, using AI to, I think it's to detect a certain response you get from frequency waves. And then the shares are trading at 34 cents a piece at an $80 million market cap and are down 53% over the past year. So there's your decrease for the past year. It's quite big, to say the least. We'll start with a look at the last quarter, fiscal Q3 2025, and this is the end of April 30th, so it's an offset fiscal year. So for the 3 months, revenue fell 26% to $3.5 million compared to $4.7 million in the prior year. Management is attributing this to delayed deployments. Given the contract nature of deployments, quarter variation is expected, really, with any business that does deal with contracts, especially upfront contracts, which about 2/3 their revenue is upfront payments, with about 1/3 being subscription based. And you can see 9 months as well is slightly down, but not anywhere near the same degree. I'd just call it up materially flat for a company with this much fluctuations on the 9 month. But zooming out, we can actually see revenue growth has actually been significant over the past few years. And it's really just been flat this last year. Gross profit fell 27%, so slightly more than the revenue, to $2 million from $2.7 million, and gross margin got a haircut to 57% from 58%. Net loss decreased further to a loss of $3.1 million from a net loss of $2.7 million, or a loss of 2 cents and 1 cent per share, respectively. And contractual backlog as well, it has increased to $15.4 million from $13.8 million. As well, the company noted that the Xtract One Gateway, that's their new product, was looking to ship in July, so this month, with aggregate orders of $6.7 million across 5 customers, which should give a bump in the coming quarter and quarters. Whether or not that comes to fruition, that's a question for management, not for me at this time. As well, the company has $21.1 million in signed agreements that are pending installation, so that's a further backlog on top of that $15.4 million, on top of that contractual backlog. So shifting to its balance sheet, it's net cash. And then in the quarter, the company had $1.9 million in cash and equivalents with no debt and lease of $1.1. That's not bad at all, but the balance sheet does not really have any leeway, given the company has been burning cash, with $2.2 million being used for operations before working capital over the past 3 months, and $5.4 million for the past 9 months. You're looking at somewhere around a $2 million a quarter in cash burn rate when you're not worrying about the working capital fluctuations, meaning the company needs to get more cash within this quarter, which they did. They raised $6.5 million after fees at 39 cents a unit, 18 million units, which includes a share and a warrant exercisable at 49 cents a piece. If the warrants are not exercised, that's about another year of cash burn at the current rate. With the warrants being exercised, that period a bit over doubles. But the shares would need to appreciate before that is likely to happen, because obviously you're not going to exercise a warrant if you can just buy the shares cheaper. And as you can see with the chart I have up, the company increases share count significantly over the past few years as the company has not been profitable. And this is the issue with pre-profit companies. They do have limited time before needing to raise. The concerning part for Xtract is that the company has stated it's been progressing towards cash flow break even since at least fiscal Q1 2024. That's the farthest back transcript I could find for the commentary. And that just hasn't materialized. Revenue has grown significantly, but the losses just haven't contracted yet. It hasn't neared that break even. Quickly valuation, as the company isn't profitable, we need to go off revenue, which is at 5 times trailing. This isn't a super discount valuation by any means. It is supported by the expectation of significant growth. When you are getting those revenue multiples of 5, 10 times, you do need growth. It's just the reality of the scenario, which does add further risk if growth does not materialize or not at a quick enough rate, which is why you've seen the stock really get hit as these delays have been occurring. And as the question mentioned it, a quick look at the total addressable market, or TAM, as the question highlights, it is big. The initial focus is $4.6 billion, and this includes stadiums, theaters, event spaces, and casinos, with expanded TAM of $39.5 billion and a global TAM of $135 billion. That's a massive total addressable market, but just because the market is big does not mean the company has a clear runway to these billions in revenues. You'll see these pretty common for pre-profitable and pre-revenue companies. They'll have these massive TAMs, or they might call it like a serviceable addressable market, some variation of addressable market, and it'll be a big number. That most of the time they're not going to be able to get anything, even a percent of that. It's very big, and they purposely do that. And as further really evidence of there's direct competition in this space. Xtract is direct competition. Evolve Technologies, another public company, EVLV on the NASDAQ, offers a similar solution. AI weapon screening. SafePoint, which is owned by Sound Thinking, Simple SSTI on the NASDAQ, which also offers AI-based weapon detection solutions. So you're not the only player in the market. So even though the market is big, in your niche in the market at this time, obviously they can expand into different areas. It is competitive at this time, and it does make these pre-profitable companies is harder to compete because obviously you're going to be competing not just technology but also price at the end of the day. And if you are competing on price in any manner, you have to obviously lower your revenue, and that's harder to scale as quick. Overall, Xtract just does not check the boxes for Keystone this time. It's not profitable and it's still burning cash, and the gap towards closing that negative cash flow hasn't really occurred at this time, despite the management mentioning moving towards it for a while now. It isn't appearing in the financials this time. That's something which we really be watching for. Is there an actual trend to what they are saying, which there just hasn't been so far, at least. While the balance sheet in isolation, it's good. The cash burn just eats away the capital, causing the need to raise cash through equity, like we have seen very recently, just in June, which ultimately dilutes shareholders. But there is no debt burden, which is nice to see. Sometimes for these early pre-profit companies, you start to see them take on debt, and they're just never able to overcome the debt, because you'll be seeing them high single-digit, low double-digit debt rate or interest rates, and it's just really hard for them to overcome it. So nice to see that they at least don't have debt at this time, but they are raising through equity. The one gateway product solution, likely having shipping in the near future, can provide a growth runway, which we can see in the notable backlog, but with delays could push out any potential growth further. The adoption of one gateway will be something to follow in the coming quarters, and that's really if you are an investor or prospective investor in the company, you want to see how that uptake occurs. Does it actually follow through with what they are saying at this time, and is it eventually profitable? Because right now they're early units, you expect lower gross profit margin. Does that gross profit margin expand over time, or does it just stay flat or decline even? And just circling back to the initial question of doubling down on a losing position, Xtract doesn't meet our GARP criteria, obviously, for investment. It never has, given it's not profitable. But I will speak a bit more generally when looking at a company that has fallen in price. A couple of simple questions you can ask. Does the company still meet your original thesis of why you invest in it, or has that original thesis broke down? You'll see many times in these early tech startups, or even something Xtract is a bit more progressed than some. Are they hitting their mark? Is the reason why you initially invested, is it because the technology is able to do X, Y, and Z and get to the market at this rate? Is that your thesis? Did they follow through on it? Does that still exist? If you have, then the next question is, if you have no position in the company already, would you invest in it at this time? If the answer is no, you probably just want to close out the position. If you're thinking, yes, I still want to invest in this company. I think it's still great. It's just not recognized by the market. It could be time to invest more. But obviously for us, Xtract does not meet that criteria at this time. And I'll pass that off to you guys if you got any comments.
Definitely.
The fact that you have any shares in any individual company should have zero bearing on whether or not you're going to invest any more in that business. And that's people get in that trap of doubling down. Oh, I can lower my average cost. So it biases towards investing in that company. You should look at that business with fresh eyes. If you wouldn't invest in it now, do not invest because you're doubling down or lowering your average cost. So, I mean, it's just general on any company. That's not on this company specifically, but you got to look at, would you invest in this company now outside of whether you hold any position whatsoever?
Yeah. And it's an interesting technology, but again, it's a story at this point. And like Brett was saying, we need to see management, execute. Like for example, look at NTG Clarity. We covered it on the podcast a couple times. They started actually really hitting numbers, and we were seeing it. We spoke with management. They said that there was going to be, a potential, further, they were going to be able to replicate this going forward. That's what we would like to see first before, a recommendation, or obviously, when it comes to this individual, do you dollar down?
NTG, we waited till it had significant earnings, right? And then, trading at 78 cents this time last year, sold half our position at 230, 240.
Yeah.
That, it's always a misnomer thinking you got to get in before the company's profitable. And that's what people might say with an Xtract, right? I'll get in before it's profitable, then it'll cross that line. You're talking about 200% in a year on a company that already was profitable and was going to increase profitability. That is investment versus this is more speculation. Also, if you look at Xtract 10 years ago, 3.4 million shares out. Today, 218 million shares. Even if you just look back 5 years, 140 to 118, just a huge increase every year because, if you don't have cash flow, you have to fund yourself either going into debt or issuing shares. This company continues to issue shares. So it's hard to make a per share earnings now for this business on its revenue level, even if they increase it significantly with over 218 million, plus further dilution likely coming from warrant exercise if they do exercise. I'm not certain at this point, but yeah, my 2 cents. Anything further, gentlemen?
I think that's good.
We're good. Aaron's got the top earnings stories from last week, including names such as Alphabet and Tesla, to close out the show.
Yes, so we are in just about the middle of Q2 earnings season in the US. So earnings season in the US typically starts a couple of weeks before it does up here in Canada. Last week was a huge week, so why don't we just walk through some of the stats? 34% of S&P 500 companies reporting results so far, 80% posting surprise EPS, 80% exceeding revenue estimates as well. However, one of the things with revenue estimates that you have to also take into account is if the expectation is low, makes it a lot easier to exceed. So the blended earnings growth for Q2 was 6.4%. This was the lowest since Q1 of 2024, even though it was still higher so far anyways than what analysts were forecasting. A blended net profit margin for the index, 12.3%. This is down from Q1, but above a year ago and above the 5-year level. And then the forward PE. So this is not the cyclically adjusted PE that Ryan was talking about. This is just the nominal PE for the S&P 500. Looking forward is 22.4 times. So this is above the 5-year of 19.9 and the 10-year of 18.4. Ryan just did a segment on relative valuations between large caps and small caps. And one of the takeaways is that valuations overall are not cheap right now for anybody. But let's take a look at some of the big earnings stories. So first company up here is Tesla, who we all know, some love and many do not. But anyways, they're encountering some difficult financial performance here. So revenue was down 12% for the quarter. Diluted EPS, so this is adjusted, so this is positive 40 cents, but they missed estimates of 43 cents from analysts, and they're down year over year by 23%. Vehicle deliveries down, energy storage down, carbon credits down. and gross margin under pressure. So they've been in a situation where they've been having to cut prices. There's a lot of growing EV competition. There's pressure on margins. I'm sure a lot of the tariff impacts don't help as well. So this is one that is encountering some difficulties, and we will keep an eye on it, but not as a recommendation, more just as a story. Because in spite of the fact that its financial performance is by far the worst of the Magnificent Seven stocks, they are trading at a valuation which far exceeds any one of them, and possibly, well, maybe not all of them put together, but at least three, any of the top three put together. Anyways, let's move on. Okay, let's talk about Alphabet, another one of the Mag 7. So robust growth, very strong quarter, but heightened regulatory risk, or not from the quarter, but just what they've been experiencing. So this has been building up. I'll get into that in a second. So revenue grew 14% year over year. Google Services revenue up 12%. Google Cloud up 32%. So cloud, of course, cloud computing, a major theme. This is a growth driver for Google, but only recently hasn't been profitable. So that's great. Operating income rose 14%. Earnings per share rose 22% to $2.31. So you look at a company the size of Alphabet, and growing the earnings at 22% is absolutely incredible growth. And really what is driving a lot of this is the AI boom. They're integrating that in their services, still strong drivers in search, strong drivers in YouTube. And of course, I talked about cloud. But the regulatory environment for Alphabet right now is very precarious. They have a number of legal challenges, antitrust, that they are facing in both the United States and in the EU. There have recently been some judgments there where they have been found liable. So really the regulatory outlook for them is extremely hazy right now. Absolutely fabulous company in terms of fundamentally, and no sign really that the growth in that business is slowing right now. But some of these regulatory issues, if they turn out in a negative case scenario, could be very impactful for the company long term. So this is something we're updating the company right now to our clients, and we'll get into good detail on that. Another one here, ServiceNow. So this is a SaaS cloud-based AI enterprise company. So it provides different AI solutions to enterprise clients through subscription services. So subscription revenue increased 22% to $3.11 billion. Almost all of the revenue was subscription revenue. RPO, so these are performance obligations, they also climbed 25%. This is an indication of future growth. Adjusted EPS strong. Full year subscription revenue guidance was raised, and company continues to highlight the robust demand for the Now Assist AI and its workflow automation solutions. So this is another company, technology-based company that is really riding the AI boom and providing interesting services in that space. But again, it's not something that is cheap at the current price. Blackstone. So this is a private equity alternative management company. We hear about it a lot. Record assets under management, also increased the dividends. So fee-related earnings were up. Fee-related revenues were up. Fairly good, strong performance across the board. As I said, they also increased their dividend. Now, one of the things about Blackstone that's really interesting is because it's an alternative asset manager and it's essentially like a private equity company, they really have the flexibility to invest in all of these interesting areas of the economy. So whether they see opportunities in AI, if they see opportunities in buying up single family housing and then re-renting them out, or in building data centers, whatever it is, they can invest. So they have a tremendous track record and lots of capital, and that's why some investors look at this company. A couple others here that also reported. So there's West Pharma, sales up 9.2%, good organic growth. Their guidance was raised, margin expansion. There's United Rentals. They raised their guidance as well. Fleet productivity up 3.3%, solid earnings. And then there's Chipotle. So they struggled a little bit. Chipotle comparable sales down 4%. I know Ryan really loves Chipotle, talks about it all the time. But they did add 61 new restaurants, total revenue growth 3%, and 32 cents in diluted EPS. So typically, when you're looking at a restaurant business, one of the key performance indicators is going to be that comparable sales growth. You don't want the company to have to continue to add restaurants to generate growth or try and reduce costs. That, for any investors in Chipotle, is a number that they will be looking to turn around. So just to kind of wrap everything up, AI, cloud computing, they continue to drive growth in the market. Alternative asset managers benefit from strong investment opportunities, capital deployment, access to capital. We're seeing softness in the EV space and a lot of competition, which is impacting Tesla. And then valuations, of course, Ryan talked about this earlier. They're valuated just on an average 22.4 based on forward earnings as estimated earnings for the S&P 500, well above the historical mean. But that sums up the week, and over the next week, we'll obviously be seeing a lot of other companies come out. I'd expect another 100 or 200 companies, so I'll just report on a couple more top stories then.
It's definitely a good summary. For me, one of the standouts there is Alphabet, a company that we've had in coverage for Google, obviously, that we've been in coverage for years now. Good quarter. I mean, there is obviously some potential regulatory risk, but it continues despite the jump in the share price. Trades at relatively reasonable valuations, given the continued growth, the accelerated growth in the cloud. We continue to monitor it, continue to like it long term. We'll be updating for clients near term.
Yeah. One standout for me is just Tesla. I mean, I've been beating this drum that their margins are going to be declining, just fierce
stand
competition.
out on the negative is what you mean.
Yeah, stand out.
Yeah,
Exactly.
yeah.
Stand out on the negative, where I've been beating this drum where, it doesn't look great for the business near term. But of course, the stock just continues to go higher. Again, I think my 2024 prediction, the stock was around like $260. I said that over 2024 it was going to decline. I was wrong. I kind of doubled down. I was wrong again. The stock just has so much euphoria continually built into it. But that just shows you can be right that, the near term numbers are going to face pressure. But some stocks just don't trade.
It's a meme stock, basically.
Exactly.
It's a meme stock now, and yeah, you don't ever bet against a meme stock because reality doesn't matter.
I mean, it is down almost 20% year to date. So
yeah,
this year
the valuation I think is up over 100 times earnings.
Yeah.
The next most expensive is maybe Nvidia at about 40, 45, right? And then you got Microsoft at 33 times, Google at 21. So, all these other companies are growing. Tesla's EPS is declining.
And I think I'd note on the year to date, that's kind of skewed a little bit too, because when the stock went absolutely parabolic when all of a sudden Trump came into office, and it was, Trump and Elon were, best buds at that time. So, the stock was just absolutely
all I can look
ripping.
at is the numbers, Brennan. I can't. They don't lie. That's what it's done year to date. I'm just kidding.
I
know what you're saying. Exactly. For sure. Trying to throw you a bone here, for God's sakes. You're right this year.
Every single time that I talk about it and think, oh geez, maybe the stock's in for a tough year, I'm just wrong again.
All right. Well, I think what? Sorry,
I was just going to say, my psychological short, or my prediction short of Palantir, has been even performing worse than your Tesla one.
Yeah.
It's about doubled since the start of the year, and that's the same valuation. Where your valuation, if you're actually shorting just purely on valuation as the whole, the market can remain irrational longer than you can stay solvent.
Yeah,
sure. And I think Palantir, it's off the gap trailing, it's nearly 700 times on a PE basis. Just
crazy.
I mean, that's why we traded value.
That's why we hate predictions, and we hate our prediction show. We like sticking to good, solid research and finding good companies that we can value over the long term. That's what we're doing. And
so we all agree no more prediction show then.
Oh, it's always fun to do. It's fun to do. We hate it,
right?
Yeah, it's true.
Yeah, but, we'll do the prediction show, but we won't base our investments.
It'll come back. It's coming back.
Brett's striving for the best, 3 or 4 years in a row, and I'm striving for that worst spot. I'm gonna be the laggard out of the four of us.
I'd rather be the worst at predictions first.
Yeah.
I just am so happy that my one really tough prediction on Musk and Trump having issues this year has already come true. So I'm
is
1
true.
for 1. That's
Yeah,
all I know.
your prediction on that was great.
Yeah.
It was I was sticking my neck out. That's all I can say.
You sure did, yeah.
Yeah.
All right. Let's end this show. Keep your questions coming in for our Your Stock, Our Take segment. We'll endeavor to answer those on a weekly basis. If you, rate or review us? That's what you want to do. If you're watching this first right now on YouTube, smash that subscribe button. If you're listening to this wherever you do consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.